If you're considering investing in bonds, here's a beginner's guide to help you understand the basics. What are bonds? Bonds are debt securities issued by governments, municipalities, or corporations to raise capital. When you buy a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount when the bond matures. Components of a bond: principal face value, the initial amount you lend to the issuer, which will be returned to you when the bond matures. Coupon rate, the interest rate that determines the annual interest payments you'll receive based on the bond's face value. Maturity date, the date when the issuer will repay the bond's face value to you. Types of bonds: government bonds, issued by governments and considered lower risk. Treasury bonds and treasury notes. Municipal bonds, issued by state or local governments to fund public projects. Some are tax exempt. Corporate bonds issued by companies to raise capital. They tend to offer higher yields but come with higher risk. Bonds are generally considered lower risk investments compared to stocks. Government bonds are typically the least risky. The return on bonds includes both the interest payments, yield, and potential capital appreciation if you buy the bond at a discount. Yield and interest rates. The yield is the annual return on a bond, including both interest payments and potential price appreciation. Bond prices and yields have an inverse relationship. When interest rates rise, bond prices tend to fall and vice versa. Spread risk by investing in bonds from different issuers and with varying maturities. Bonds are typically sold in denominations of $1,000, but you can buy fractions through ETFs. Higher-rated bonds are considered lower risk. Duration measures how sensitive a bond's price is to changes in interest rates. Some bonds may have limited liquidity, making them harder to sell before maturity. Diversifying your bond portfolio helps manage risk.